Hi guys, it's Stock Curry, and in today's video, we're going to go over some economic news that came out today. I'm also going to go over the timing of the Fed meeting on Wednesday so that you know what time information is going to get released so that you can plan accordingly. So let's get into it! First up, we got the Producer Price Index numbers on Tuesday, and the PPI, Producer Price Index, rose 0.8%, which is double what it was in April. Now that's really bad, not only because it shows even on the producer side inflation increasing when we expected it to decrease, but furthermore, the producer price index inflation eventually works its way over to the consumer side. And so what this means is as the PPI or producer price index goes up, it means we can expect the CPI or consumer price index to rise in the future. So this is not good news because it means inflation is continuing to rise and it is showing no signs whatsoever of slowing down. The 10-year Treasury also topped 3.48%, which is the highest in 11 years. We have not seen the 10-year Treasury this high since the fallout from the 2008 financial crisis. Now, this is a big problem because when the 10-year Treasury rises, the stock market falls. So as the 10-year Treasury continues to rise through fears of the Fed raising interest rates faster than expected, we can expect the stock market to continue to fall. So we've got to keep our eyes on the 10-year Treasury. We don't want to see it rise any further, but right now it just keeps on rising and it doesn't look like it's going to slow down. On the housing side, the 30-year mortgage rate just surged to 6.28%. It was at 5.5% just a week ago. Now, this is a major problem for an upcoming recession because when the mortgage interest rates hit 5.5%, that officially put us at the most expensive housing market in history. And now that the rates are up to 6.28%, we are well above the most unaffordable time in history to buy a house. Meaning if you consider the mortgage payment, looking at the average price of a house and the average mortgage interest rate, that gives you an average mortgage payment. If you then take that mortgage payment and you divide it by the average monthly income, that gives you a number, and that number puts us at the most unaffordable housing market in history, meaning never before in history has the average monthly mortgage payment been this high compared to the average monthly income. It is really bad, and people think the mortgage rates are going to continue to increase at a substantially faster pace because on Wednesday, the Fed starts its quantitative tightening, and on Wednesday, the Fed starts its mortgage bond runoff, which is going to cause these mortgage interest rates to rise even faster. So things are already bad. They're about to get a whole lot worse, and we are already seeing a decline in the amount of home sales. In fact, home sales have now fallen for the past 6 straight months in a row. And of course, as demand continues to go down, that's going to very quickly fix our supply problem in the housing market. We are very quickly going to get back to what's considered a healthy level of number of homes for sale, and it's going to very quickly go beyond that to where we enter into a buyer's market where home prices start to decrease rapidly. It's coming. There's every single sign for it already there, and it is just a matter of time before home prices start to fall. Now, as the housing market starts to cool off, real estate firms Compass and Redfin both announced layoffs. Compass announced a 10% cut to its workforce, and Redfin announced an 8% cut. This is the start of layoffs that we're starting to see in the real estate market. And as more and more industries start laying off employees, this is going to balloon very, very quickly. And just to show you, it's not just the housing market. Coinbase cut 18% of its workforce today. So layoffs are starting to show up across every single industry, across every single sector. And as more and more companies lay off employees, this is going to cause a major, major problem. I mean, this is how massive, major recessions start. And we are seeing it more and more and more. We're seeing more and more companies announce layoffs. And this is going to balloon us into a major recession very quickly. the central bank, specifically the Fed, now sees higher unemployment rates on the horizon. Federal Reserve officials are beginning to signal that higher unemployment rates might be necessary in order to lower inflation by raising interest rates. In other words, the Fed is saying that it's going to be necessary to put the US economy into a recession in order to get inflation down. They say this is fine, they're willing to do it. So this is not good news. We are now finally, for the first time, seeing the Fed stop talking about a soft landing, and now they're actually going out and saying, no, we need to put the economy into a recession. It's going to be required in order to get inflation down. Now, of course, everybody already knew it, but the fact that the Fed is starting to say this is not good news, because it means that even once we are officially in a recession, they might continue to raise interest rates until inflation comes down, no matter how bad the recession gets. So this could be a really bad sign for the future. It looks like the Fed's biggest concern is stagflation. They don't want to be in a situation where the economy continues to fall during a recession while inflation remains high. It looks like they're just going to go all out, tackle inflation, knock it down, get rid of it, even if it puts us into a major recession, so that we don't end up in a situation where we have stagflation. And of course, the Fed's stern message about unemployment needing to rise and the need to raise interest rates and put us into a recession just in order to fight inflation is starting to cause a lot of worry about stock market valuations. Even with the S&P 500 down 22% this year, many investors and analysts fear the stock market valuations have further to fall. The S&P 500 traded Monday at 15.8 times its projected earnings, or an average forward PE ratio of 15.8. Now, the average PE ratio for the S&P 500 is 15.7, so we're about 0.1 higher than the average. Now, you might be saying, great, then we're almost at a bottom. We're finally about to bottom out, finally about to get down to normal valuations. We can start going back up again. Well, not so fast. There are two major issues that we have to look at. First of all, historically, valuations fall much further before bottoming out. In the sell-off of 2018, the S&P 500 fell to 13.8 forward PE, and in March 2020, the S&P 500 fell to 13.4 forward PE. Keep in mind that markets don't typically bottom near the historical median. They tend to overshoot on the downside from a valuation perspective. Now, we're talking about valuations of 13.4 and 13.8 during the 2018 and 2020 recessions. But if you go back to 2008, they fell below 10. And right now, they're at 15.6. So we really have a lot further to fall just on the forward PE ratios and how the stock market normally falls in a time of correction like this. Normally, we're going to fall well below that 15.5 average. We're going to get all the way down into the 13s. And you say, okay, fine, great. Then maybe we fall another, 20% or more and we bottom out. Well, not so fast. It gets even worse. The problem is that we're talking about forward PE ratios as they currently stand. Now, let me try to put this in perspective for you. Let's say there's a stock that's trading at a price of $150, and the 15-year forward PE, or the 15-year forward earnings are $10 a share. So if you take that $150 price and you divide it by the $10 earnings, you end up with a price to earnings, price divided by earnings, 150 divided by 10, it's a PE of 15. Okay, that's how that works. $150 price divided by $10 earnings equals a PE of 15. Okay? Here's the problem. As the economy goes into a recession, and as companies start to lay off employees, and as earnings continue to go down, the PE ratios will start to rise. Let me explain how that works. Let's say you take that same $150 stock price, but now instead of there being a forward earnings projection of $10 a share, now that forward earnings projection has been dropped down to $5 per share because the company expects lower earnings due to the recession, maybe an overstock of inventory, things like this. So the earnings drop from 10 to 5. So instead of doing $150 divided by $10, which gives you a PE of 15, you now do $150 divided by $5 earnings. That gives you a PE of 30. Now, if we're at a PE now of 30 because future earnings projections have gone down, that causes the PE ratios to go up. Well, in order for this new PE of 30 to get down to 10 to 13 for the market to bottom out, it now has to drop another 66% before it actually bottoms out. And you say, well, Scott, the stocks are already down 50, 60%. How much further can they possibly fall? Well, they could easily fall another 60, 70% from here. And by the way, when we're talking about this sort of math, I'm not talking about a 60% already plus 60% from highs. Let's be ridiculous. That'd be 120%. Stocks can't fall more than 100. So think about it. It already fell 60%. We're talking about 60% from the current level, right? Maybe a 80% total from highs. So think about that, guys. It could come. And this is why when people say the stock market could fall 80% from highs, this is what they're talking about, is as PE ratios increase because earnings decrease, the stock price has to fall significantly more in order to get that PE ratio down to that 10 to 13 range where the stock market will actually bottom out. So don't think that just because we're at a 15.6 PE now and we have to get down to around a 13 to bottom out, that we're getting close. Not at all. Because PE ratios are going to rise as companies continue to decrease their future earnings guidance. And as PE ratios rise, it means the stock price is going to have to fall significantly more to get down to undervalued. So all of this combined, I think it's very clear that we are in for a lot more hurt and a lot more pain in the stock market, and we are nowhere close to a bottom. Nowhere close. It is going to be a long time before we hit a bottom in the stock market. Now, there is a lot of historical indications that we could bottom out in October and the stock market could rise in November and December. We'll have to see if that's the case or not. It depends upon how fast the stock market falls, how fast the recession starts. It depends upon a lot. It's still way too unknown to even guess when the stock market's going to bottom out. But what we do know is the stock market's going to go down a lot more before it even comes close to bottoming out. All right, now let's talk about the Fed meeting that's coming up on Wednesday and the timing of it so that you can get an idea on how you might want to set up any trades, especially if you're looking to day trade. So the Fed meeting started on Tuesday. It continues through Wednesday. Now, at noon Eastern time, the Fed should release their decision on what they're going to do with interest rates. So at noon Eastern time, we should know if the Fed's going to raise interest rates by 0.5%, 0.75%, or 1%. That'd be 50 basis points, 75 basis points, or 100 basis points. So we're going to find that out at noon on Wednesday. Then at 2 p.m. on Wednesday, Jerome Powell's going to speak. Now, this is about 2 hours before the market closes. And those last 2 hours before the market closes very often will completely wipe out whatever the market did before then. Because it's really what Jerome Powell says that's going to matter the most. Now, when Jerome Powell first starts speaking, he's going to give an economic summary, a recap of how the economy is doing. We already know it's bad, really bad. And we can expect the stock market to fall as Jerome Powell first initially starts to speak. But what really matters is when he starts answering questions. Now, his pre-written remarks will last anywhere from 15 to 30 minutes. After that time, he will start answering questions, and that's when the stock market's really going to start to move. Now, it really depends upon what he says and what he forecasts for the future meetings. Right now, the stock market is pricing in a 75 basis point rate hike at this meeting. So if we get 75 basis point rate hike, that's what the market is pricing in. We should not expect too big of a price volatility in the stock market if we get that 75 basis point rate hike. If we get a 50 basis point rate hike, which would be far better than what the market's pricing in, we should expect the stock market to rally on Wednesday before Jerome Powell starts answering questions. If we get a 1% rate hike, then we can expect the stock market to tank on Wednesday before Jerome Powell starts answering questions. And then once he starts answering questions, what the stock market does is anybody's guess. It really just depends upon what he says. If he comes out and he acts very hawkish, if he mentions the name Paul Volcker, if he talks about putting the economy into a recession in order to get inflation down, any of this could cause the stock market to fall significantly on Wednesday. If Jerome Powell does what he's done for the past few meetings and is very dovish and says, we're just going to wait and see how the economic numbers come out. We're not making any decisions. We're not changing our plans at this time. We're just going to wait and see. And he's very dovish. We could expect the stock market to rally on Wednesday. It really depends. There's no way guessing this. There's no way to predict this. Most of the traders I know are just sitting on their hands waiting for Jerome Powell to start answering questions, and then they're going to open their positions at that time. But if you're day trading, you can expect the stock market to move a little bit before noon. You can expect it to be pretty big movement from noon to 2 p.m., depending upon what the interest rate hike is. Then you can expect a movement to the downside from about 2 p.m. to about 2:15 or 2:20. And then from there, it all depends upon what Jerome Powell says. So I hope that helped. I hope you got a lot out of this video. If you want to know what trades we are making and how we're trading this throughout the day, you can follow along on our trades in the VIP Discord. We'll be posting all of our trades that we make in the VIP Discord so you can follow along and make money with us. If you are interested in that, you want a little bit of hand-holding through this time, you can come join us at stockcurry.vip/getvip. That's stockcurry.vip/getvip. We provide coaching, trade alerts, as well as training to help you become a successful trader, especially if you want to learn options. That's really my strength. That's really where I focus. So most of my training and coaching is on options. If you want to learn options, come join us, stockcurry.vip/getvip. All right, guys, I hope you enjoyed this video and got a lot out of it. Don't forget to hit the like button and subscribe. And if you're on YouTube, go ahead and click the bell icon and click all. I hope you have a lot of success trading, and I will see you tomorrow.